Effect of changes in foreign exchange rates. Guys, overall this standard actually applies to two things. One is foreign currency transactions. Other one is foreign operations. Earlier it used to apply to even forward exchange contracts, but later on as the standard evolved, that portion was removed from this and was included as a part of financial instruments. Otherwise it had another part called as forward exchange contracts. Not applicable for IPCC level because it's a CA final portion. There's no point of discussing them. We'll only be talking about these two things. Foreign currency transactions and foreign operations. What exactly are these two parts? First, let's talk about foreign currency transaction. What do you call as a foreign currency transaction? In simple sense, any transaction which is denominated in foreign currency. We will see what a foreign currency is. But any transaction which is denominated in foreign currency will be satisfying the definition of foreign currency transaction. When I look at this word foreign currency transaction or any transaction which is denominated in foreign currency, I can say that it is a transaction for purchase or sale, or it can be a transaction for advance or loan. I have advanced funds in foreign currency. I have lent funds in foreign currency. Anything can come up and we can say that it is a foreign currency transaction. So I purchased goods in foreign currency. I sold goods in foreign currency. I have exported goods or I have imported goods. I have lent funds in foreign currency. Now I have lent funds, so someone wanted some money. I had surplus cash, so I have given it to some foreign currency fellow. Now such transactions, or I have lent funds. I have actually borrowed funds from a bank in US. Reason why I could have actually lent in US rather than actually lending it from here, Indian bank, is probably the rate of interest. Here the rate of interest is whooping high, 12%. I would have gone to US and I'll borrow funds at 5%. Cheaper flow. So it could be a cheaper source of funds I can actually borrow there. So such transactions can be called as foreign currency transaction. Now whenever we are looking at a foreign currency transaction, I said something called as foreign currency. What exactly is foreign currency? To define a foreign currency, I'll say it is other than home currency. What exactly is this? When I say other than home currency, then what exactly is a home currency I'm talking about? When I say home currency, don't give reference to rupee or something else, because the standard applies to everyone. So when I say home currency, it is a currency in which my financial statements are prepared. This is what we talk about as far as a home currency or a foreign currency is concerned. Home currency means the currency in which I am drafting my financial statements. If my balance sheet, my P&L, my cash flow statement and my notes to accounts are presented in form of a rupee, then rupee becomes my home currency. And any currency other than a rupee will become a foreign currency. Now you will say, sir, all Indian enterprises normally present in rupee terms. What difference does it make? Now guys, absolutely correct, because your Companies Act 2013 says that your financial statements which are of a company which is registered under Companies Act either in Companies Act 1956 or 2013 should be presenting its financial statements in rupee terms. Absolutely right. But we have plenty of organizations which are not registered in India. They are not companies, they are not registered under Companies Act 1956 or Companies Act 2013. But they are still doing some business establishments in India. Take a look at Facebook. Facebook is an organization which is there in India. They are having an office in India. There are so much multiple trade which is happening in India. So many advertisements which are coming up. Everyone is actually doing some transactions. But is Facebook a registered organization in India? Absolutely no. They have registered themselves in US but conducting operations in India. Apple, the product sales that are happening for Apple in India, you can call that it is a transaction which is happening in India for a company which is not registered in India. Now, for enterprises which are in India but actually are a registered enterprise outside India, they need not present in rupee. Because if you look at someone like Facebook and Apple, ultimately understand when they want to present the entire group entity as a whole. When Apple presents that my total sales are so much, that means it is sales not just done in US. It is sales done in US, sales done in UK, sales done in India, sales done in China. Now every currency sale put together, they will say that their annual sale is so much. So when they want to club the figures or combine the figures, is it possible for me to denominate all the Indian sale in rupee, all my US sale in dollars, all my UK sale in pound? If I do this way, how will you add? How will you add the figures? $1 plus 1 rupee plus 1 pound is equal to $3 rupee pound. Not possible. How will you add like that? 1 kilometer plus 1 meter, how much? We can't say that because we have to make sure that we are actually bringing them into relatable currencies. One unit I have to maintain. If one single unit of measurement if I have, it will be easier for me to add down all the figures. So what these people start doing, though they are enterprises in India, conducting business in India, transactions made in India, but the entire reporting might happen other than in Indian currency. It need not be happening in rupee. They might be actually presenting their financial statements in dollars, saying that it is my home enterprise which is in US. It will be easier for me to consolidate with them. So never always be of an impression that if an enterprise is in India, they will present their financial statements in rupee. Wrong concept. They will always present in the financial statements in the currency in which it is more comfortable for them. It is comfortable for them to report in dollars, they will do it in dollars. The compulsion is only to those people who are preparing financial statements and they are registered under Companies Act of India. If they are under Indian Companies Act 1956 or 2013, then the compulsion comes up where we say that it should be presented only in rupee terms. But if they are presented, if they are not a company which is registered under Companies Act in India, they can present as per whatever they wish. It depends on what currency that they are following, what Companies Act that they have been following. So this way you will find there could be an enterprise in India for whom home currency need not be a rupee. But strictly for example purpose, we will always take it as home currency as rupee. Okay, for our example purpose. But there could be definitely entities in India but still doing business where the home currency for them, the statements in which they have actually drafted their financial statements could be other than rupee as well. Now let's say for example, I am talking about a transaction. I have purchased a machine. Now such purchase of machinery from, let's say I bought it from Germany, normally famous for its machinery, on 15th August 2017. Let's say it was in euros, denominated in 1 lakh euro. Now I have purchased it from Germany for 1 lakh rupee from one party X, and the settlement date let's say is about 15th of April 2018. So I've been granted enough credit period. So the credit period is ending on 15th of April 2018. I have a transaction this way and I'll have to make sure that I'm doing the settlement up to this date. Let's see how the recording happens. First thing, when did you acquire? My acquisition of machinery is on 15th August. So I'll start on 15th August and I'll start recording. 15th August 2017. I'll record. What did I buy? I bought machinery. Debit what comes in? Machinery account debit. To Messrs. X. Now, when I buy this transaction, when I record this transaction, I have bought it at how much price? 1 lakh euro. Now, how do I record it at 1 lakh euro? I am basically an Indian entity. For me, everything is reporting is happening in rupee. All my journal entries, my ledgers, my trial balance, my balance sheet, my P&L, entire set of financial statement drafted in rupee. Only one transaction, how will I write in euro? It is not possible for me to record in euro, so I'll have to make sure that I'm reporting in rupee only by converting this euro into rupee. Now, first thing, what I will do, let's say the exchange rate of euro to dollar or euro to rupee on that particular day was, let's say, about 60 rupees. And what I'll do, 1 lakh into 60, today I will record the transaction at 60. Then I will come down to 31st March. On 31st March 2017, I'll have to first spot which is a monetary transaction and which one is the non-monetary item in this. What is monetary, what is non-monetary first of all? Let's try to understand the distinguishment between monetary items and non-monetary items. If I talk about a monetary item, in simple sense, a monetary item is either receivable or it is payable in fixed sum of money. Now look at my asset side and tell me. Fixed assets, monetary items, fixed assets, receivable or payable in fixed sum of money. Building 1 lakh, receivable in 1 lakh, receivable 1 lakh rupees receivable from the building, or 1 lakh rupees payable to the building. That means it is non-monetary. Same way, investment of 1 lakh in equity shares of Infosys Limited. So Infosys Limited will give you 1 lakh rupee for the shares that you bought. You are having an equity interest in the company. Stock, 1 lakh stock will give you 1 lakh. Sale of stock will get converted into debtor. Such debtor will give me 1 lakh, not the inventory by itself. Stock by itself will not give me. So stock, non-monetary item. Then come down below. What else is there? Debtor, monetary. Monetary item again. Debtor is monetary. Bills receivable is monetary. Cash is monetary. Bank is monetary. Because it is fixed sum of money. The money portion is very much fixed. So I can take some examples out here. Debtors, bills receivable, advances which I have given, deposits which I made, cash, bank, etc. Anything that you can write. When I talk about non-monetary items, then what are these non-monetary items? Simple logical sense other than monetary items. But when I say other than monetary items, plenty of items come off in this perspective. Guys, I have written only receivables, okay? You can write payables also under monetary items because it is receivable or payable. Opposite to debtors. Creditor. Creditor is payable in fixed sum of money. Bills receivable. Bills payable. Fixed sum of money payable. Advances. Loans. Payable in fixed sum of money. So cash, bank overdraft. Bank overdraft is payable in fixed sum of money. So all those will also come under monetary items there. Clear? Now when I look at non-monetary items, I just said other than monetary. Such a vague definition, man. Such a vague definition. That means in my balance sheet, if I separate that these are monetary items, all those which are left out will all belong to non-monetary items only. So what we will try to do is we will bifurcate these items into better classification. How do I classify? I'll classify them into two types. Those which are carried at historic cost and also those which are carried at fair value. What are those which are carried at historic cost? I'm talking about examples in the form of fixed assets, historic cost. One more example if I want to give, I'll write it as long-term investments. My long-term investments are also non-monetary items carried at historic cost. If I talk about fair value, I can take stock, inventory, current investments. These are the ones which are measured at fair value. So what am I doing? For the purpose of the standard, I am splitting all the items in the balance sheet into two types. One we call it as monetary items, the other one which we called it as non-monetary items. Now in a simpler understanding, let's say, if I have a trial balance, guys, if I normally have a trial balance, my trial balance is a summary of all ledgers. When I say all ledgers, such ledgers can be real ledgers, personal ledgers or nominal ledgers. Whatever it is, everything is summarized into trial balance. Then let me put it like this. Personal, real, nominal. All my personal accounts are basically monetary items. All my real accounts are non-monetary. Look at the examples. Look at the examples that I have given. Nominal, I am not classifying any further. Nominal items, I will still continue to call them as nominal. I will not change the nomenclature under ASLEP. These non-monetary items, again I have classified them into two types and I said these are carried at historic cost and those which are carried at fair value. Let's see now. We'll go back to the example. In the example, the first entry that you have written, machinery to X, now you spot. Machinery, classify. Non-monetary item carried at historic cost. Then what about this X? Monetary item, because it is a person. It's a personal account of Mrs. X. So personal accounts are all monetary in nature. So monetary item, this one. So always spot the monetary items first. On balance sheet date, first I will pick up the monetary item and I said Mrs. X is a monetary item and always we will have to take the exchange rate on balance sheet date. Exchange rate of euro to rupee on balance sheet date was 65. Now look at it. How much should I pay X? I should pay X 1 lakh euro. Now I am not supposed to pay X 60 lakh. Even if I transfer 60 lakhs to Mrs. X account, he'll say, what is this? I don't understand your currency. I sold you the goods at 1 lakh euro. It is your responsibility to give me 1 lakh euro. At the time you acquired, sir, it was 60 lakh rupee in my rupee term. I'm not bothered about it. I want 1 lakh euro. Now, on balance sheet date, if you have to settle the transaction, to buy 1 lakh euro, how much should you pay? I have to buy each euro at 65 rupees. Like that, I have to buy 1 lakh euros and remit it to Mrs. X. Each euro at 65, that means I have to totally pay 65 lakhs. Look at Mrs. X now. I only recorded it liability at 60. Don't you think extra 5 lakhs liability has already arisen? Why did it arise? Because of increase in foreign exchange rate. So what I will do? I will credit Mrs. X to Mrs. X. And I will record extra 5 lakh liability. Now on what we know is, no entry can be recorded like this. There should be a debit also which can be recorded. So now what you will say? Sir, it was a machinery which I purchased. So the machinery purchased was not 60, has now become 65 lakhs. Remember, increase in value of an expenditure, capital expenditure, can only happen when there is a increase in utilization or utility that you derive. By paying extra amount, just by your euro increasing, your utility from the asset increased. So earlier the asset, since the euro was normal, it was only working like this. Since euro increased, the machine also started producing extra. Not possible. So that means I can't debit it to the machinery account. So instead what I will do, this amount of debit, I will call it as exchange loss. It's a loss which arises because of fluctuation in foreign currency rate. This I am doing it on balance sheet date. When is my settlement date? I came down to 15th April. 15th April 2018. I want to settle the transaction. On that day, I found that the exchange rate of euro to rupee was only 63. Now I have to pay. So let me pay cash. To cash or to bank. How many pounds should I buy? How many euros should I buy? 1 lakh euro. Each euro I have to buy at 63 rupees. How much will I spend? Whom am I settling this to? I am saying this to Messrs X. Let us debit Messrs X then. How much is liability of Messrs X now? 60 or 65? 65. Initial liability 60. Extra liability 5. Now total that follows debit is 65 lakhs. Where did your entry tally, man? My entry did not tally. 65 lakh rupee of a liability, I am settling by only paying 63. I saved 2 lakhs. I saved 2 lakhs. This 2 lakhs will be called as to exchange gain. Debit all expenses and losses, credit all incomes and gains. On the credit 2 lakhs. This is how we will record a transaction when we are looking at foreign currency transaction. In a simpler sense, if I have to actually summarize it, then I'll put it like this. Recognition, measurement. Look at it now. First, when did you record the transaction? On the date of transaction only I record. First, initial recognition. My initial recognition should happen on the date of transaction itself. On the date of transaction, what rate should I use? What rate did I use to translate this? I have used 60 rupees, that is the exchange rate on date of transaction. On the date of transaction, I will use exchange rate on date of transaction. Next, when did you do subsequent recognition? After the first entry, when did I record? Balance sheet date. Guys, did I record both on balance sheet date? Both the items were re-recorded on balance sheet date? No, machinery I did not. I recorded only X, Y. Only monetary items should be considered. So on balance sheet date, only to the extent of monetary items, all my monetary items should be translated using what rate? What rate did I use? 65. What is 65? Exchange rate on balance sheet date. This exchange rate on balance sheet date is also called as closing rate. If I go as per the terminology given in the standard, we will calling it as closing rate. the rate at which the books of the accounts were closed. That is closing rate. Then after that, did we stop here? We have done even one more recognition on settlement date. Again, what items did I translate? Only your monetary item. Did I use machinery account again? No, that means only monetary. What rate did I use now? Exchange rate on settlement date. This is my recognition and measurement of foreign currency transactions. Take that example. Make sure that you are recording each entry. Summarize the entire recognition and measurement criteria. I'm still talking about the first part. I'm still talking about foreign currency transactions. I haven't come to the foreign operations yet. This is regarding still the first part, foreign currency transactions. We have summarized the recognition and measurement and we have written it this way. First recognition on the date of transaction, use the exchange rate on date of transaction. Subsequent recognition will happen only for the monetary item. Monetary items are those which are receivable or payable in fixed sum of money. Such items which are monetary in nature will always measure it at exchange rate on balance sheet date, on the balance sheet date measurement, and such exchange rate will be called as closing rate for us. On settlement date, again we will remeasure only monetary item using exchange rate on settlement date. Whenever you are doing subsequent recognition either on the balance sheet date or on settlement date, we have been getting to one ledger here, exchange gain or exchange loss. Such exchange gains and losses should be charged to P&L immediately. So write down below, exchange differences arising, exchange differences arising should be charged to P&L immediately. Could be a gain or loss, guys. Exchange difference need not be only a profit. Here in the example itself, I have taken a gain in one situation and loss in another situation. XYZ Limited sold goods to ABC Limited in US for 5,000 USD. Such transaction happened on, take some random date. What is today's date? 16 Jan 2018. Let's say this transaction is to be settled it's a 3 months credit period, so he is settling it on 16th April 2018. I'm giving you multiple exchange rates, guys. Exchange rate given to me as on 16 Jan 2018, exchange rate was 65 rupees per dollar. By the time I came up to 31st March 2018, became 67 rupees per dollar. As on 16th April 2018, the date of settlement, came down to 63 rupees per 62 rupees per dollar. Can you just write accounting entries for this? Done. Shall we discuss the entries? First entry to be passed on 16th of Jan. ABC Limited account debit. 2 sales. Entry will be for $5,000 multiplied by 65 rupees per dollar. Exchange rate on date of transaction. How much is this? 30. Much? 3,25,000. Yeah. Immediate next transaction for me. Subsequent recognition only on balance sheet date, only for monetary item. What is a monetary item in this? Sales are nominal in nature. Only this is monetary in nature. Since it is monetary in nature, we'll have to recognize it at the closing rate. The closing rate was 67. So my amount receivable, ABC Limited, will be debited again extra. You have recorded at 65. Now you have to record at 67. That means 2 rupees per dollar extra. Receivable increase will become exchange gain. All exchange gains should be transferred to P&L. I'll write the entry exchange gain account debit to P&L. Next settlement date 16th April 2018. I've received only $62, 62 rupees per dollar. Bank account debit. I've received $5,000. I've received it at 62 rupees per dollar. So that means I've received only 3,10,000. But if you look at my ABC Limited had a debit balance 3,35,000. The amount of 25,000 will be considered as exchange loss, which should also be transferred to P&L. This is basically how the accounting happens. Fine. Now, this was the first part of the standard talking about foreign currency transactions. Now we'll have to look at something called as foreign operations. What are your foreign operations? It is my enterprise doing operations other than in the home country. What operations can they do? They can do either in the form of a subsidiary, they can establish a branch outside. Normally here when we look at, we are talking about branches. If you remember branches, we had two types of branch. One is independent, other one is dependent, correct? We had either an independent branch or a dependent branch. I'll change the nomenclature, guys. I don't like the names of independent and dependent. So for the purpose of your AS11, this independent branches are called as non-integral foreign operation. Non-integral foreign operations. Dependent branches for my purpose of AS11 are called as integral foreign operation. Now what is the concept of foreign branches? If you remember the branches were branch accounting, the concept regarding the foreign branches was already dealt there, and we had a problem because when I look at organization's financial statement, it includes all branches. Now I'm an Indian enterprise having a branch in US. US branch did its own transactions, had its own purchases, had its own sales, made sure that it was paying its own expenses. Entire trial balance when they drafted the entire trial balance in dollars. When I asked them, give you a trial balance, I have to incorporate it into my trial balance as well, and we'll prepare one single set of financial statements. He gave me a trial balance, everything was in dollars. While unlike the situation of the home enterprise which was in rupee, I can't straightforward add because I have a problem. Since this is a dollar, this is a rupee. So what should I do? Convert all this dollar into rupee, make it into home currency, and then add it with your home currency trial, your home enterprise trial balance, head office trial balance. Now when I'm translating it, these provisions will apply, and such provisions are called as translation provisions. What are you translating? Foreign operation trial balance, correct? So I am basically translating my trial balance, and for the purpose of AS11, we have already classified the trial balance, right? For the purpose of AS11, what did we say? Your real accounts have become non-monetary. Again, these non-monetary items also, we have split them into two types. Those which are carried at historic cost, those which are carried at fair value. Along with that, we also divided them into monetary items. One more classification was still left out without a change in the name. Now such trial balance have to be translated for both integral foreign operation and non-integral foreign operation. Out of that, guys, I am specifically blocking around this item. Why only this item block? I'll tell you. Because this is the only difference for integral and non-integral. All other items you will have same. The translation impact is absolutely the same. It is only the integral and non-integral change will appear only for non-monetary items which are carried at historic cost. Non-monetary items carried at historic cost, if it is an integral foreign operation, I'll have to apply some exchange rate. Some exchange rate I need to multiply so that the dollar becomes a rupee. Now what exchange rate am I applying? If it's an integral foreign operation, I'll apply exchange rate on date of acquisition. The date when I have acquired, what was the exchange rate? I'll apply that. But when I'm looking at non-integral foreign operation, for those non-monetary items carried at historic cost, I'll simply apply closing. What was closing rate? Exchange rate on balance sheet rate. Like I told you, except for this item, all other items, the exchange rate to be multiplied will be same. Be it integral, be it non-integral, my exchange rate to be multiplied is absolutely the same. So let's look at the second one. What is your non-monetary items carried at fair value? Exchange rate on date of determining fair value. The date when you determine the fair value, what was the rate? When we look at monetary items, we simply apply closing rate. When we see nominal items, we apply exchange rate on date of transaction. but I'll put a small asterisk mark on this table, especially with nominal items. I'll tell you the reason. How many nominal items normally can you think a balance sheet could have? Non-monetary items carried at historic cost, fixed assets, few. Monetary items, slightly more. Nominal items is what? Expenses, incomes, gains, losses. Now, rent, electricity, salary, office maintenance, printing and stationery, miscellaneous expenses, what not. You have so many ledgers which are there, so many transactions within each ledger, and each such transaction coming under a nominal category. If you take exchange rate on date of each transaction, per day how many transactions are there? If I even have 300 working days in a year, 300 working days, 300 different exchange rates. How many transactions? At least 5 to 6 transactions of nominal in nature. You and I will incur 5 to 6 transactions, man. Think about it from the morning that we wake up, your traveling cost, your food, yes, you go somewhere, you go for a movie, then the movie ticket cost. Now all these are nominal transactions. Every day in, day out, we at least do 5 to 6 nominal transactions. Company doing 5 to 6 nominal transactions, and basically they are not doing any business. Okay, so 5 to 6 nominal transactions is basically that. So on an average, let's say they have done 10 transactions in a day, 300 days, working days. So total 3000 transactions. 3000 transactions should be multiplied by 300 different exchange rates. Practically not possible. Because it sometimes gets too enormous of an activity to actually use such items. So why I put as asterisk is because whenever it becomes impractical, he's saying that if impractical, use average rate. Guys, normally trial balance tallies. Yes. If I multiply each item of the trial balance by 10 rupees, trial balance will still tally. If I multiply few items in the trial balance by 10, few items by 9, few items by 11, few items by 15, but trial balance will tally? No, it won't tally. Same thing is happening here. Each item of the trial balance, you are applying different exchange rates for it. Had everything been applied on the uniform exchange rate, trial balance will tally. But since they are applying different exchange rate, it is not possible for your trial balance to tally. So there will be some exchange difference which will appear. There will be some exchange differences which we can categorize as exchange gain or exchange loss. Again, exchange gain or loss, I will start bifurcation between integral and non-integral, because if I look at an integral for an operation, such exchange differences will be charged to P&L. But if I look at non-integral operation, then I have to charge it to another reserve called as FCTR. What is FCTR? Foreign currency translation reserve. We have seen this when we are talking about branch accounting. Yes guys, so now we have to think about reclassification. What reclassification am I talking about? Earlier it was an integral for operation, now it became non-integral. Or earlier it was non-integral, now it became integral. Two types of reclassification can happen. First reclassification is integral to non-integral. Or else it could be non-integral to integral. . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . What is the item which is a point of discussion now? Whenever you reclassify, I don't have a problem with these items. Because these items from here till here, whether it was integral or it was non-integral, I was using the same exchange rate. So these won't change. My problem is only arising with respect to non-monetary items carried at historic cost. Here also the point of contact or point of discussion will be non-monetary items carried at historic cost. Here also point of discussion is the same. Non-monetary items carried at historic cost. Now, what happens here? Integral to non-integral with respect to non-monetary items carried at historic cost. Non-monetary item carried at historic cost, until it was integral, I was using exchange rate on date of acquisition. Now suddenly I am using exchange rate on balance sheet date, closing rate. So what is happening here? The difference between closing rate and exchange rate on date of acquisition there is a difference which arises because of closing rate and exchange rate on date of acquisition. This difference I will transfer to, what is it now? It was integral before, became non-integral now. In non-integral, exchange differences will be transferred to foreign currency translation reserve. Talk about this one now. Non-integral to integral. What is the difference? Earlier when it was non-integral, I was always using closing rate. Now when it became integral, I have to use exchange rate on date of acquisition. So the amount of difference is nil. I won't get any difference. The reason is because date of reclassification is considered as date of acquisition. I'll tell you why he did that. This is easy. Integral to non-integral. I purchased the asset long back. At the time when I bought, I know what was the dollar rate. I kept on applying the same dollar rate throughout all years. Today it became non-integral, straightforward. Today balance sheet date, I know what is the closing rate. I multiply it over, whatever difference I got, I put it into FCTR. Happy, cool. Life all shanti. The second part, the problem arises because until today's date, I was taking at closing rate. On today's date, no sir, it is integral now. Go find out what was the date of acquisition, what was the exchange rate on the date of acquisition. Sir, we don't have detail. No data is available, sir. As of today's date, we don't have any idea. The asset was purchased somewhere in 1947. On 15th of August, exact independence date was given. What exchange rate will you get now? So that is the reason why he said sometimes it becomes too impractical to actually decide upon that. So he said better not take the exchange rate on date of acquisition. Instead, your date of reclassification itself will be called as date of acquisition. So what is happening? Throughout you will take it not based on exchange rate on date of acquisition, but it will be exchange rate on date of reclassification will be considered. Clear? So that's why the difference will not be there. Difference is nil. The accumulated FCTR should not be transferred to P&L on the date of reclassification. Should not be transferred to P&L on date of reclassification. Break that right down. FCTR will be transferred to P&L only on FCTR will be transferred to P&L only on date of disposal. On the date of disposal of foreign operation. Only on disposal of foreign operation. Yes, guys? So that is my translation provisions. So how do you translate a foreign operation into your home currency? Now, this looks like we have come to the end of the standard, but that is where a new paragraph was inserted. This is called as para 46A. Should you remember the paragraph? Actually, it is better you remember this one. Because if you go to MCA website, Ministry of Corporate Affairs website, and download the standard, you'll have only 46 paras in it. Go to ICA website, download the standard, you'll get 46A as well. Okay. The reason was basically this paragraph was introduced as a part of amendment to the standard. Now, what amendment was required in a standard? The standard is quite foolproof standard. What amendment did they do? The amendment was basically regarding something called as transitional provisions. By name, it actually meant it was for a period of transition. That's it. That means transitional period is very small period. Probably a year, 2 years at the max, that is transitional period. So what according to the standard says that with effect from 7th December 2006. Now you're telling me, sir, I'm talking about 2018, you're talking about 2006. How fair is it? From 7th December 2006 up to 31st March 2009. Again, you'll say, not relevant for me. Not relevant for me. I'm already 9 years from there. Then what happened was, they have changed this to 2010. Extended it to 2011. Said, ठीक है यार, एक और साल ले ले यार. Take it 12. Now they thought, one more year if I do, people will slap me. So what they did? So this provision is applicable up to 2020. So starting from 2009, they gave 1 year extension, 1 year extension, 1 year extension. Up to 2012 they took. Straightforward they put it off to 2020 now. What exactly is this transitional provisions and what significance does this dates have here? According to your transitional provisions, if an entity has taken long-term foreign currency borrowing, and with the help of this particular long-term foreign currency borrowing, they have acquired a depreciable non-monetary asset. I am saying depreciable non-monetary asset means I have to buy a fixed asset because it is depreciable. That too I can't buy land. Now in this process I am acquiring a non-monetary asset using a long-term foreign currency borrowing. Such long-term foreign currency borrowing by nature are monetary. Correct? Whenever we look at monetary items, I have to go back to my foreign currency transaction. All monetary items should be restated on the balance sheet date using a closing rate. Such monetary items should be restated at closing rate. On each balance sheet date. Fine. When you restate, it will always give rise to something called as exchange gain or loss. Correct? This also we have seen. And what did we say? Such exchange gains and losses should be transferred to P&L. What new thing this fellow said then? What was so new? It is the same thing you are writing again and again, what you have written already. I did not write what the transition said. What the transition said is, you can adjust to the cost of the asset. And this is one such option which I am giving you. One option which you already have, which you are always doing the same thing, which is charging it to P&L. Along with the option of transferring it to P&L, which you would have anyways done, I am telling you, I am giving you an extra option. I said you can choose this. Instead of transferring it to P&L, you can adjust it to the cost of the asset. And I said, these options are irrevocable. That means once exercised, you can't reverse it. Now, what benefit am I even looking at, and why has this come into picture? If I have an exchange loss, what you would have normally done? Entry? P&L to exchange loss. Now I am saying don't write P&L to exchange loss, write it as asset to exchange loss. Now you will say, sir, unfair. Something which should have been debited to P&L, you are routing it to an asset. Wrong or no? I will say it is justified because it is a depreciable asset. If you increase the cost of the asset, what happens to the depreciation? Depreciation also increases. So subsequent period, instead of writing it as an exchange loss, in the subsequent period it will come into your P&L as increased value of depreciation. But still, somewhere it gives relief to most of the industrial entities because you are not charging the amount at one point of time. If I am charging on the depreciation on the useful life, so the benefit or the amount is being charged to P&L over the entire useful life of the asset. Let's say the useful life of the asset which I have acquired is 15 years. Instead, if I go with option 1, I should have transferred the entire exchange loss in the same year. But if I am opting for option 2, 1/15th of the amount is only going into the P&L in the form of depreciation. The remaining 14 portion will be again carried forward for subsequent year in the form of depreciation. So that means my incidence into the P&L is somewhere diluted to a major extent. Now, why did he give such provision, and was it really required, or is it some malified intentions which are actually there in this? I wouldn't really say too much of malified intention which happened, guys. This was basically a time of recession when the global world was hit. We were nice only. We were all comfortable, but the global world was very badly hit at that particular point of time. We had a very strong banking structure which helped us at least stay afloat. But a lot of people who are basically dependent on the multinational companies were severely affected because each multinational company was actually exposed to a lot of risk. So there were a lot of disturbances which are happening at that point of time. The global banking economy has seen the decline of two major banks in the form of Merrill Lynch and Lehman Brothers. Two huge banking sectors. Merlin's was a huge banking, Lehman Brothers was a very huge banking segment. At that point of time, there was a threat even to the Bank of America, saying that Bank of America might also announce their insolvency at any point of time. That is when the government stepped in and said that no, we will aid you people, please don't panic the crowd even more. At that point of time, the rate of borrowing in US came down to something about 2 to 3% per annum. In India, normally unorganized segment, that is per month lending. Per month we normally charge that. Okay, in an unorganized sector, I am not talking about organized sectors. Unorganized sector, normally 2 to 3% is nothing. It's a very, very small amount in an unorganized sector. But instead, US was actually charging it per annum. So what people will do? Especially Indian people, we will borrow. Send 1% to US, talk to the banker, borrow funds, 2%, 3%, get it back to India, convert it into rupee, buy whatever you want, invest in whatever you want. The problem was not that. We would have been welcoming people to borrow in dollars, no problem. If it is economically beneficial to that fellow, I don't have a problem if he is converting it into dollars. The problem happened because at that point of time, dollar dropped down to 38 rupees. Now we are borrowing. That means we want more and more dollars are in our hands. So what is happening? We are only increasing the demand for the dollar. We want more and more borrowing in dollar. Dollar demand kept on increasing. Over. 38 became 40, 40 became 42, 42 became 45, 45 became 50, 56. No one, people are not even able to understand where it increased. At a point of time where we realized that it almost touched 70. Over. Record exchange loss. Record exchange loss. 32 rupees per dollar. Leave about that 2%, man. बाद में गया तेरा 2% because in a logical sense if you look at, I am basically paying 2 times the amount of borrowing which I have taken. Now which even if you are borrowed in India, the cost of the fund wouldn't have been that high. So logically these people made a huge mistake by doing that because they never expected the dollar to bounce back so strongly in that region. So this exchange loss which kept on occurring every year, they started identifying it in 2009. So in 2008-9 financial year, then they gave with retrospective effect up to 7th December 2006, with retrospective effect, any borrowing which was taken after that date, if it is falling before 31st March 2009, whatever exchange differences you have been charging to P&L, entire exchange difference you accumulate and add it to the cost of the asset. Got it? If it is an exchange gain, sir, next time I will take it to P&L. Absolutely wrong. That's why I said it is an irrevocable option. If loss you have added to the cost of the asset, gain also you have to deduct it from the cost of the asset only. You can't choose whatever you want each year. You have to opt once and you have to continue opting the same thing every year. Got it? So this is a typical adjustment which comes up in 46A. A new paragraph, a transitional paragraph which was introduced at a much later point of time. Pick this up.